In this lecture, we're going to be talking about paid future absences, things like paid vacation and sick days. The accounting term for these is compensated absences, and they're a part of salary expense. They're also a really nice example of how accrual accounting forces us to think carefully about timing, because GAAP requires companies to record an expense when the vacation time is earned. Let me set this up with a scenario that you'll all relate to soon if you haven't already. Imagine you just landed a great job. Congratulations. And your compensation package includes, say, 2 weeks of paid vacation a year. Here's the thing, you don't earn all of that vacation on January 1st. You earn it gradually as you work throughout the year. By the time you've worked 6 months, you've earned roughly a week. You're earning that paid time off as you work today, but you might not actually take it. And the company might not actually pay for it until much later, maybe even next year. And who knows, maybe you'll have gotten a raise by then. So when should the company account for the expense, and what should they do when you actually go on vacation? Although paid vacation is the most common type of compensated absences, there are other types of paid absences, like Although paid vacation is the most common example of compensated absences, there are other types of paid absences, like sick pay, which also accumulates and often may carry forward to future years. There are also holidays, personal days, and so on. The logic is the same for all of them. Because employees earn these benefits by working today, the matching principle tells us that the cost belongs in today's period, the period in which the work is performed, not the later period in which the time is finally taken. If we wait until someone actually goes on vacation to record the cost, we'd be matching the expense to the wrong period entirely, which would compromise the usefulness of our income statement. So we know that we're supposed to recognize expense for compensated absences when they are earned, but GAAP outlines 4 specific conditions that must be true to avoid any confusion. First, the obligation relates to services employees have already rendered. They've earned it by working. Second, the rights either accumulate or vest. Accumulate means unused time carries forward, and vest means that the employee is entitled to be paid for it, even if they quit and leave the company. Third, payment is probable. The company expects to pay the employee for the time. And fourth, the amount can be reasonably estimated. When all 4 are satisfied, we have a present obligation. In practice, for something like vacation or sick pay, these conditions are usually met, so companies accrue the expense and recognize a liability for the estimated amount. Let's look at the entries. As employees earn the paid time off, typically recorded at the end of the accounting period, we debit salaries or wages expense and credit a liability, often called something like liability for compensated absences. This puts the cost in the period that the work was done and sets up the obligation. Then, later when the employee actually takes vacation and gets paid, we debit the liability, not expense, and credit cash. Notice that the expense was already recognized earlier when the time was earned. The later entry just settles the obligation that we already set up. That's the whole point. The expense and the work provided line up in the same period, even though the cash goes out later. Let's work through an example. Here we have 8,000 employees that each earned 2 weeks of vacation during the year. We also have average wage rates for this year and next, and a schedule outlining the number of days off that they actually took. We'll accrue expense and record the liability as the days are earned, then record the payment when the time is used. Before we begin, let's do a little bit of math. We need to calculate the number of weeks taken by our employees so we can record that journal entry. So we have 2,500 employees that took 2 weeks of vacation. So taken is 5,000 weeks for those employees. Then we also have another 2,000 employees that have taken 1 week of vacation. So we'll add 2,000 weeks to that. Our other employees are saving theirs up. So we have 7,000 weeks taken, and their average compensation was $600. So if we want to record the salaries expense for that, the 7,000 times $600 will give us $4.2 million here. So I'm going to start with that journal entry that occurs during the period, and we'll debit salaries expense here for $4.2 million. And we will credit cash for $4.2 million. Now, at the end of the year, we need to make our adjusting entry for the vacation that was not taken. And our first 2,500 employees took all their vacation. We don't need to consider them, but the 2,000 employees that stocked up a week, we'll add those in there. And then the 3,500 employees that haven't taken any vacation, they've got 2 weeks. So that's a total of 7,000 weeks that have not been taken, 9,000 weeks overall. And we will also multiply that by 600 to arrive at our adjusting entry amount of 5.4. So this is also salaries expense that we need to record at the end of the year. So we'll debit salaries expense for $5.4 million. And instead of crediting cash, we're actually going to credit a liability account. We'll call it compensated future absences. But really, any liability would do. Some companies might even choose to call it just salaries payable for vacation. But this is how GAAP refers to it. So we'll use compensated future absences. Then the final thing that happens is those employees actually took some vacation during the next year. So they took all of that vacation time, but they've all gotten a raise now. So now our $600 that we had used before, it's not enough. So we're going to calculate what that $9,000 or 9,000 weeks is at 635. And we're actually going to get a number that's a little bit bigger than we recorded, $5,715,000 at the end of the year. So, or during the next year. So next year, when they take that vacation, we can eliminate our compensated future absences account that had 5.4 million in it. But that's not all of the cash that we're going to be paying out. So we also need to debit an additional salaries expense for that extra $315,000, and we'll credit cash. And that will complete the accounting for this transaction. To summarize, compensated absences are compensation that employees earn as they work. So by matching principle, the cost belongs in that period. We accrue an expense when the employees actually provide their services, along with a few other specifics outlined in GAAP. We record a related liability as the expense is accrued and the time is earned. And when employees actually take the time off and we pay them, we reduce the liability and recognize the cash paid because we've already recorded the expense.